You ever wonder if you're using your car to the maximum potential to help you save on your tax bill? Today I'm going to be talking about whether it's good or bad to take the standard mileage deduction. Should you save all your receipts? Should you lease? Should you buy? And just how to use your vehicle to lower your tax bill. Now, you're probably familiar with the standard mileage deduction, and it's a concept that a lot of accountants push because it's really easy to do the calculation on your tax return every year. The way that it works is the IRS determines a standard mileage amount, and for 2010 it's 50 cents per mile. And then you simply need to state how many miles you drove related to business for the year. You take the mileage multiplied by the 50 cents per mile, and that becomes your deduction on your tax return. But have you ever stopped to think just how much it actually costs to drive your vehicle? Fortunately, AAA publishes every year the amount it costs to drive various types of vehicles. And for 2009, it might surprise you to know that it costs way more than 50 cents per mile to drive certain types of vehicles. In fact, the only vehicle that 50 cents a mile actually covers would be a really small compact car, such as a Ford Focus. So if you're driving something substantially bigger, you may be losing every time you turn your key in the ignition. So here's some tips to help you use your car to lower your tax bill. Consider the difference between the standard mileage deduction and actual expenses. I just mentioned that it costs you way more than what you're allowed on the standard mileage deduction. So here's what you need to know. Make sure that you keep documentation of all your expenses. You need to actually know how much it costs you to drive your vehicle so that you can take those deductions. Some of the things that are deductible are the obvious: fuel, insurance for your car, registration fees, maintenance costs for your cars, so all those oil changes, other things like new tires and fixes to your car, repairs. Those can all be deductible expenses. So make sure you're first of all keeping track of those. Credit cards are great for that because you can simply go back to your statements and sum up the totals for the year. Otherwise, you might have to go the hard way of saving up all the receipts and using a calculator tape to keep track of those expenses. So the bottom line is you've got to have good documentation so that you first of all know how much it's actually costing you. The second component is the way it's deductible. Automobiles are what's known as listed property, and that simply means that it can have a dual purpose. You're probably driving your car for business, but you're also using your car for pleasure as well. And while we all do that, we're only eligible to deduct the business-related portion of those expenses. So what happens is, rather than taking 100% deduction on all of those expenses, you're allowed to take the business use percentage of those expenses required to maintain your vehicle. So you also need to keep track of the mileage, and it can be as simple as using a log to track down your mileage, but you don't have to use the brute force method of documenting each and every mile that you drive. There are alternatives that are acceptable. You can track your mileage, for example, 1 week out of every month and then multiply by 4. You can keep track of your mileage for 3 months out of the year and multiply by 4. You're getting the idea, but the important thing is you do need to have documentation. So get in the habit of keeping a notebook or keeping an electronic record, perhaps in an iPhone or some other smartphone, but you have to be able to go back in an audit and prove that mileage deduction. Once you know how many miles related to business you've driven, you can simply take that in a mathematical equation. That becomes the numerator. You divide by the total number of miles, and that percentage then gets multiplied against all of the expenses that you spend to maintain your vehicle. That becomes your deduction. So try it out. Chances are you'll find that you're losing money if you're using the standard mileage deduction for deducting vehicle expenses. Now, the other question I get commonly asked all the time is it better to lease a car or purchase a car? And the truth is that in the end, it all comes out to roughly about the same. The difference is in the timing of when you get those deductions. Now, of course, when you lease a vehicle, you've got a lease payment that's established, and you're paying that every single month over the life of the lease. And if you were to add up all those years of leases, you come up with one grand total, but it's pretty straight line. In other words, it's the same amount every year that you're roughly able to deduct. On the flip side, if you were to purchase a vehicle through the wonders of depreciation, you might be able to get a slightly larger write-off up front. So in the earlier years of owning that vehicle, you'll get a slightly larger deduction, and then that tapers off over the life of that vehicle, and you have less of a deduction in later years. So at the end of the day, what you need to ask yourself is, what does your tax situation look like? Are you expecting to pay roughly the same amount of tax over the life of that vehicle? Or are you expecting to, for example, owe more tax now and have a lower tax later in the future? In that case, you might consider buying a vehicle. If the opposite is true and you have a lower tax now and you expect taxes to go up in the future, a lease might be a better option because it's a way of evening out those deductions and saving them up, if you will, for a later time when taxes are higher. Hopefully you found this discussion helpful, but it can really help to sit down with a good proactive advisor who can help you run through those calculations and make sure you're not leaving money sitting at the gas pump instead of using it to lower your tax bill. So, it's not too late. If you've been taking the standard mileage deduction, you can change that and use it to your best advantage. But the bottom line is that using a one-size-fits-all approach can cost you thousands of dollars. The best defense is a good offense, and being prepared and working with a good proactive advisor. Remember, certified tax coaches are specially trained to help you keep more of what you earn, because it's not how much you earn that's important, it's really about how much you keep that counts. Until next time, thanks for joining me.